In this video, we tell you an incredible story about Sears, from where the retail giant struggled to adapt to changing times to its downfall. Hello everyone, welcome to our channel. If you're new here, kindly hit the subscribe button and turn on the notification bell to get more videos like this. Let's get started without further ado. Sears was once the largest retail in the world and a financial powerhouse, owning a variety of businesses from insurance to real estate. During the holiday season, its stores would be packed with shoppers looking for a variety of goods. However, today, the company only has a few large format stores left compared to the thousands it once operated. Many of its stores have been divided into smaller spaces or repurposed for other uses, while others remain vacant. After a 4-year bankruptcy process, Sears has emerged as a much smaller company, which is a significant decline for a retailer that defined American retail for more than a century through its mail-order catalog and network of stores. The unexpected end of Sears' decline was due to a variety of factors. The retail industry underwent significant changes, including the emergence of specialty clothing chains, discount stores, hypermarkets, and e-commerce giants like Amazon, which dominated the market. However, underinvestment and dismantling by Eddie Lampert, a hedge fund manager who was expected to save the company, also contributed to its downfall. Lampert oversaw the sale of the company's corporate headquarters, proprietary brands like Craftsman and Die Hard, and most of its jobs, despite his promises to preserve them. Investors are puzzled as to why a billionaire like Lampert tried so hard but still failed to save Sears. According to Steve Azerbad, managing director of TradeGuard, Sears would have been better off liquidating 10 years ago due to the lack of investment. Lampert, who played multiple roles in the company, including investor, creditor, CEO, and owner, failed to turn around Sears but ensured his interests were protected, benefiting from years of spin-offs and sales, which were the focus of a recently settled consolidated lawsuit with creditors and the Sears estate. According to the Bloomberg Billionaires Index, Lampert is worth $2.6 billion and was accused in a lawsuit of benefiting himself as Sears became insolvent. Creditors claimed in a legal document that Lampert's forecasts for the bankrupt company were unrealistic at best and deceitful at worst. They referred to the ups and downs of the company during his tenure as a Shakespearean tragedy. Lampert and ESL Investments did not provide a statement for this and have previously denied the accusations against them. Transformco, the holding company that Lampert founded after Sears' 2018 bankruptcy, is a diverse company that aims to develop various areas of business. They are focused on capitalizing on the strong customer loyalty to the Kenmore, Craftsman, and Die Hard brands, even though Sears has already sold these brands. However, Sears still holds the licenses to sell and create new Die Hard products. The beginnings. Sears, originally called Sears, Roebuck & Company, was established in 1893 as a mail-order business for watches and jewelry. It remained America's top retailer until the turn of the century and was a popular store for Americans even before the rise of Amazon and Walmart. Sears' Big Book catalog offered a wide range of products, including mail-order houses. However, when Lampert bought Kmart Holding Corp's debt for $700 million in 2002, the once popular discount chain had already filed for bankruptcy. Lampert later merged Kmart with Sears in 2005, despite skepticism from critics. In the early years, the combined company cut costs and profits surged, leading investors to be optimistic. They were especially attracted to Sears' vast real estate portfolio, assuming Lampert would sell the properties and dismantle the companies. However, this did not happen. and Sears and Kmart struggled for years, resulting in nearly $11 billion in losses before their bankruptcy. Lampert and his hedge fund were sued in 2019 by creditors and the insolvency estate, alleging that they had benefited from asset reorganization at the expense of creditors and Sears. Lampert controlled Sears by using his hedge fund to lend to and invest in the company, while also serving as its CEO and chairman. He made hundreds of millions of dollars from interest, commissions, and selling assets, but also invested hundreds of millions in the company. However, lawsuits accused Lampert and his fund of improperly transferring $2 billion in assets before the company filed for bankruptcy, causing delays in the bankruptcy exit. Former directors and board members, including Steve Mnuchin, were also named as defendants. The $175 million settlement reached in August was not what the creditors and the bankrupt estate wanted, but it allowed the company to pay part of the legal costs and emerge from bankruptcy. Sears acknowledged that all of its directors and officers acted in good faith. The merger of Sears and Kmart initially brought investor enthusiasm and ambitious growth targets, but decisions that used to take months could be made in a single meeting. But there were also signs of chaos, says the former executive, citing the rejection of a deal his team had been negotiating for more than a year with appliance maker Whirlpool Corp., one of Sears' biggest suppliers. Lampert argued that the agreement was not good enough and ordered that it be changed, which it did. That damaged Sears' relationship with Whirlpool, the former executive says, and Whirlpool did not take action to the request from the comment. The former executive also recalls the weekly 2-hour meetings on Thursdays when about 20 people would gather in a conference room only to be bombarded with questions via teleconference by Lampert, even from 2 rooms away. He often looked down when his executives spoke and were usually not happy with what he heard, says the former manager, who describes those meetings as a post-mortem. Alan Lacey, who was the company's chief executive before and for a few months after the Sears-Kmart merger, says he liked Lampert and respected his investment record before Sears. According to Lacey, the hedge fund manager was looking to control Sears, not just because of the company's real estate value, but also wanted to expose the mistakes of the retail industry. Lampert pontificated that retailers spend too much on marketing, advertising, stores, and inventory commitments. He believed that profitability and free cash flow could be improved across the industry by spending less in these areas. Lampert knew retail well on a strategic level, having made several successful capital investments in the industry. After having operational control of Kmart for a while, his convictions grew stronger. But unlike Warren Buffett, to whom he was often compared, Lampert had trouble putting that knowledge to use, some ex-managers say. Buffett found a way for operational staff to work with him, which Lampert never did, says Lacey, who served as a corporate director after leaving Sears. Sears had a lot to figure out. The competition was coming from all sides, with Walmart and Target Corp having taken over new markets like the Northeast and liquidating regional competitors, while discount department stores Kohl's Corp and other rivals were opening hundreds of stores outside of the U.S. malls. Also, the headquarters in the suburbs of Chicago suffered shakes. Sears cycled through 4 CEOs before Lampert took over himself in February 2013. He preferred to run from his office in Connecticut and then in Florida, where he lived most of the time in a lavish estate on Indian Creek, a private island for the ultra-rich. Lampert was a CEO who would always prefer to be in the background. That's not a criticism, it's an observation. But the managers felt their presence. Everyone who was a CEO, including me, wasn't one. As the majority shareholder, Lampert was effectively the CEO. When he finally couldn't find anyone, he officially took over. At the start of 2012, the company reported a staggering loss of $3.15 million for 2011. A litany of transactions followed as Sears burned the furniture to warm the house, as analysts put it. There were sales and spin-offs, often after attempted sales of stores and other assets, including the Sears Canada division, which later went bankrupt, and the valuable clothing brand Land's End. Sears adaptation. Sears tried to adapt as it experimented with store formats, including a program to convert hundreds of Kmarts into spaces that combined Sears merchandise with convenience items, which are invested heavily in digital operations at the time of the merger. Sears had a leading presence in the e-commerce industry, and Lampert continued to support it, and even tested a new format for online purchases and store pickup called My Gopher. It subleased space in some of its stores to other retailers, including Dick's Sporting Goods Inc. and Britain's Primark, and closed thousands of unprofitable stores as part of Lampert's vision of a more efficient chain with fewer and smaller stores. It even started selling Kenmore appliances through other retailers. But Sears continued to sell assets, including its Craftsman brand of tools. Deals like that would later form the crux of the challenge that creditors and the bankruptcy estate brought against Lampert's purchase of Sears. The plaintiffs argued, in essence, that Lampert had removed valuable assets from the company, knowing that Sears was insolvent and would not recover. ESL said the claims were unsubstantiated and all transactions were made in good faith. The final move came in 2015 when Sears created the Seritage Real Estate Investment Trust, consisting of more than 200 stores, raising $2.7 billion and putting a portion of its most valuable assets out of reach of creditors. Despite an early investment by Buffett, Seritage shares never rallied, trading below $12 today. Meanwhile, losses at Sears Holdings continued to mount by billions as the company spent the cash it raised. This year, Lampert put Seritage up for sale and resigned as president. As more and more Sears pieces were dismantled, even its employees began to question Lampert's motives. In 2019, a group of current and former Sears employees submitted a written statement to the bankruptcy judge accusing Lampert of leading the company through an excessively long liquidation process and fearing that he would destroy the company if he bought it. Creditors argued that Sears was more valuable dead than alive, and suppliers who were owed money preferred a liquidation to a reorganization. Despite investing a significant amount of his own money in an attempt to revive Sears, Lampert's hedge fund assets shrank from $15 billion in 2006 to about $1 billion in 2018 due to a large bet on Sears. When Lampert's initial offer to buy Sears at the bankruptcy auction was rejected, the company prepared for liquidation as no other buyers came forward. However, Lampert returned with a higher offer, and after urging the parties to find a way to save the company and its 50,000 jobs, Judge Robert Grain allowed Lampert to buy it out with a better offer. The creditors filed objections alleging misconduct by Lampert and his fund ESL, but their objectives failed. That's all for today, folks. Thank you for spending some time with us. If you found this video interesting, let us know what you think in the comment box. Make sure to hit the like button and notification bell, and subscribe to our channel to get access to more interesting videos from us. While you are here, kindly click on one of the other two videos you see on your screen. See you there.